Any more of ado, let's go on to slide 5, which gives a quick corporate snapshot. What we've just been in the process of undertaking, obviously, is the acquisition of Ebony Energy in an all-scrip deal. The EGM was last week, and we ended up with 99.93% of votes cast in favour. And on the Ebony side, we crossed the 90% threshold of acceptances last week also. So we're looking to go unconditional and wrap that up within the coming week or so. Our biggest shareholder is still Tribeca Natural Resources Fund, and they've been supportive and very supportive of this latest transaction that we're completing right now. Slide 6, got the team there. So obviously Leanne, our CCO and business development head, is on the line also. I'll let Adam introduce himself when he jumps on to talk through a couple of pages time and give you some background in terms of his experience. And page 7 just has a summary of our project portfolio. Obviously, we still have the legacy projects. So the portfolio, we've still got the legacy graphite projects. Leanne's been working hard in terms of finding partners that we can work with to advance those, while honestly speaking, management is going to be very much preoccupied with the Pedirka Blue Hydrogen Project, both the PFS, which we're about to kick off, as well as taking things forward from there. And we'll give you all the milestones that we're looking to achieve over the next 12 months in a moment when we're a little bit further on in the presentation. So what we've become aware of is, while there's a load of press around hydrogen at the moment, you know, there's relatively little understanding in terms of either the state of play of the industry currently or the plans that are being made for the future in terms of transition to a hydrogen economy. So, you know, the most important factor today is that 96% of hydrogen is produced from hydrocarbons, basically fossil fuels, oil, coal, and gas. Only 4% is produced through electrolysis, where you're splitting water into obviously hydrogen and oxygen. And of that 4%, really only 1% is actually using green energy, renewable energy, as the source of power for that process. So it is, you know, a far cry from the way that hydrogen is being touted in the market at the moment. What we want to show you through this presentation is the shift is not from hydrocarbon to electrolysis. The shift is from brown and grey CO2 emitting to clean. And so what we'll show is that if you look at government policy and customers, they are agnostic between green and blue as long as it's non-emissive. Okay, so the important thing is that you don't have a carbon emission into the atmosphere as part of your process. So if we go on to slide 10, maybe you want to take it from there, Adam.
Yeah, so just firstly, a little bit of background. I was first introduced to Ebony Energy back in 2016 when I was an executive at General Electric responsible for the energy businesses. Back then, Ebony approached General Electric to look at gasifying the coal and injecting or creating methane to inject into the pipeline network. That was really a play around trying to solve for the still ongoing gas crisis, natural gas crisis that exists on the east coast of Australia. Then back in May last year, Stephen Gerlach, who's the chairman of Ebony Energy, approached me and just asked me to help him out with, you know, is the project viable? And at the time, the Ebony board of directors had actually picked up on the hydrogen economy and the paper that was just released back in late 2019 by Dr. Alan Finkel, which is the National Hydrogen Strategy and Technology Roadmap. Dr. Alan Finkel was the Chief Scientist of Australia at the time. So in May, I joined Ebony Energy and started looking through some of the challenges to the project. And to put it in context, the Pedirka Basin, which you can see outlined in the image on the right-hand side, or our tenements, are 217 kilometres southeast of Alice Springs, nearly 1,500 kilometres south of Darwin. The tenements are within areas bounded by a drilling campaign that was done by Central Petroleum back in 2009. And that's what actually gives us good confidence on the resource. Although we don't have a JORC, Central Petroleum did quite extensive work and actually did gain a JORC compliant exploration target in the area. And since then, we've drilled one well of our own to get a cross-section analysis of where the seams are falling, and to get some detail on the coal itself, because we didn't get that from what we saw from Central Petroleum. We do have subbituminous coal ranging from 5.5 to 5,800, which is a good calorific value. The coal itself is low ash, which is super important for gasification, and the coal has also got a good moisture content, which is also important for gasification. So between May last year and probably September, we spent the bulk of the time looking at how do we solve for the social license, which is dealing with the CO2 from a gasification process. And the irony of the situation is, if you look at the biggest Scope 1 emitters in the country, it's the LNG facilities around the borders of the country that are the biggest CO2 emitters in the country, but no one really talks about those emissions. But for a project like us using coal, we're going to have to deal with CO2, and what we've found is a pathway that we believe is highly viable to dealing with CO2.
Why is that? Why do the LNG? Is that because they're existing operating?
Yep.
Yeah, that's it.
Yeah, didn't have to deal with social license, didn't have to deal with lock the gate, didn't have to deal with all the things that have changed in the last 6 to 8 years.
Yeah. Okay.
So what we've identified is a pathway for our CO2 to be carbon neutral, which is super important, and that puts us in the clean hydrogen category and blue hydrogen. So what actually looked like a remote, almost impossible mission actually has some significant benefits to it. That is, we've got a lot of coal, but there's plenty of places in Australia that have a lot of coal. But we're close to existing reservoirs that are depleted, oil and gas reservoirs that are the perfect geological formation for CO2 sequestration. That is going to be one of the single biggest challenges for any blue hydrogen project in any country, is actually being able to solve the CO2 problem. So we've got 3 possible solutions. Solution number 1 is enhanced oil recovery. So we've spoken to a number of the oil and gas producers in the area. They're interested in receiving CO2 to enhance their oil recovery. The number 2 is CO2 sequestration. So basically filling an old reservoir with CO2 in what's called a supercritical fluid state. And scenario 3 is some technology we've got access to through an Israeli development, which actually converts CO2 through an electrolysis process to hydrogen. So we're sort of trying to explore a number of different avenues. The reality is the bulk of the CO2 will most likely be sequestered into a carbon capture and storage cabin. Charles, next slide.
Okay, so as well as where we lie within Australia, it's important to understand where Australia lies within the hydrogen market and the potential. We expect the hydrogen market to be geographically segmented in the same way that the gas industry is from a global perspective. Essentially, you've got North America, Africa, Europe, and Asia. And Asia actually has some of the highest plans for demand growth in hydrogen, mainly off the back of Japan and Korea's very ambitious roadmaps to transform to hydrogen economies. They've been very specific in terms of their plans and their future targets. You'll also see that they've announced an awful lot of infrastructure build out, but that's mainly to do with distribution and import terminals. Very little of it is actually to do with the production of hydrogen in either Japan or Korea. And so they're looking to Australia to be a major exporter and source of hydrogen to make that transition happen. Within Australia, the Northern Territory is probably the most advanced in terms of their hydrogen planning. I guess given the fact that Darwin obviously is a hub for LNG at the moment, they see it as a rational progression to make it a hub for hydrogen also. And so the fact that we have rail link and pipeline links up to Darwin from Alice is a huge help. And the fact that, you know, we're 3 days closer sailing time to Japan and Korea obviously makes Darwin a natural export hub for that material as well, rather than the eastern seaboard. So we're pretty excited about the opportunities which are opening up there. And what you're seeing is that the Japanese trading houses and Korean chaebols are starting to try and identify projects and put their finger on future supply to be able to secure enough offtake for that domestic need. Okay, moving on to 13. It's something that Adam's touched on already, but you know, historically we've had this grey-brown hydrogen industry, which essentially is the carbon dioxide footprint is basically being emitted into the atmosphere. The thing that differentiates blue is essentially capturing that CO2 in the process and then having a solution for that, be it enhanced oil recovery, industrial usage, or sequestration. If you look at a lot of carbon capture and storage stories around the world, the issue that they have is actually the capture component of it. The storage is relatively easy. It's the separation of CO2 from other gases in processes in the atmosphere and so on and so forth. Luckily, we're using essentially a closed loop system where there are only 3 things in the process. There's carbon, there's oxygen, and there's hydrogen. We're obviously taking the hydrogen out and we're left with either carbon monoxide or carbon dioxide. Carbon monoxide gets recycled back into the process, then the CO2 gets tapped off for sequestration. What we've seen recently is a number of Australian projects trying to present themselves as blue hydrogen projects, but actually they're looking at carbon offset, which means basically carbon credits or alternative things like tree planting programs and so on and so forth. So as far as Japanese government and consumers, and in fact the Australian government goes, they are not blue hydrogen projects. Blue hydrogen basically means 0 CO2 emission. The way that the governments look at it is it clean hydrogen, i.e. 0 CO2 footprint, or is it dirty hydrogen? They're agnostic between whether it's blue or green. Okay, so that gives you some color on that.
Yeah. Thank you.
Adam, do you want to jump in on this one?
Yeah, so what's quite clear but not talked about regularly in the press is countries such as Japan and the EU through their EU hydrogen strategy are very focused on the role that blue hydrogen will play in developing hydrogen economies. So Japan is very clear on the need for blue hydrogen post 2030. The EU has a view that it's far longer than 2030, and certainly BP, per the graphs below, believes that blue hydrogen has a role to play out past 2050. And that's an important point to understand, particularly when you're looking at the type of infrastructure that we're talking about here, the cost of that infrastructure, and the and basically how do you have a project that has a long life and good returns. So why are people focusing on blue hydrogen? You know, countries like Japan and the EU. Well, blue hydrogen is economically more viable today than what green hydrogen is. And we're not having a conversation about green versus blue, right? We're having a conversation about how do you develop the hydrogen economy, and in developing the hydrogen economy, how do you get the most out of it? And the simple message is, without blue, you won't get the most out of it. And that's seen in these graphs from BP, who basically talk about, you know, what will the hydrogen economy look like by sector if we have an emissions-based approach, which is the left-hand side. And you can see quite clearly that it's BP's view that, you know, the hydrogen economy by 2050 will be more than double the size in a net zero environment than what it will be in an emissions-based environment. The type of industries that will consume hydrogen by 2050 will be power, transportation, building infrastructure at a commercial and industrial level, and the current participants in that space, which is industry. The graph on the left-hand side really shows that what's the blend of hydrogen and where's it come from. So Charles has just talked to us through, you know, grey, blue, or grey, black, blue, and green. And, you know, by 2035, grey still has a role, okay? So it's more than just, you know, everything is about green hydrogen, which is a very easy deduction to make when you listen to the press and the hype. But grey still has a role through to 2035. But more importantly, if you take the forecast from BP, blue has an equally important role all the way through to 2050 as what green hydrogen does. And that's really because of cost, scale, and continuity of supply, which we'll cover in a couple more slides' time. So, you know, the facts are countries such as Japan and the EU are backing blue hydrogen. You know, countries are developing carbon capture and storage solutions to enable blue hydrogen to be developed. And it's more economically viable in the short and medium term. You know, we spend a lot of time looking at green hydrogen as well, right? It's an important part of the equation, but my experience from GE tells me that, you know, it took 20 years for wind to make the advances that it made in the following 10 years to take the levelized cost of energy from $150 a megawatt down to $35 a megawatt. You know, it takes time for technology to get to the commercialization point that will enable certain things to then progress, and hydrogen's no different.
Yeah, economics will prevail, I guess, right? And so grey hydrogen, I know that's not really the focus, but is grey going to continue on an offset basis then? Is that how it will continue?
Well, grey, as Charles said in like slide 6, I think it was, it makes up for the majority of hydrogen produced today.
Yeah.
So really, it's the green and blue catching up with grey at a production scale level. That's, you know, the first part of the equation. Now, whether this is on the money or not, you know, I don't have a crystal ball, right? We're talking 2035 and 2050, but it's about the economics. As you said, Chris, economics will prevail. So this next slide is, you know, Charles touched on this before. The Australian government is agnostic as to whether it's green or blue. They just want clean hydrogen, okay? When Finkel wrote the National Hydrogen Strategy and Technology Roadmap, he was very clear on the need for $2 a kilo of hydrogen. What we also know, and I'll come back to that $2 a kilo because it's quite an important point. What we also know is that the likes of the Australian Hydrogen Council, and I was on the phone the other day to the CEO, Fiona Simon, that they accept that blue hydrogen needs to be developed first to enable an export industry. You know, when you hear, other than Twiggy, and I've worked for Twiggy, I know what the machine's like. Other than Twiggy, everyone else is talking about 2027, 2028 type project timeframes, even for green, and they're projects before they FID, right? That's not even, you know, when they'll actually be producing. So, you know, the government and the Australian Hydrogen Council know there's a need for blue hydrogen. They are clear on the role it plays in developing the supply chain. The likes of Santos, AGL, and Woodside are all getting after blue hydrogen projects. Probably the most significant aspect of it is Santos, which is, you know, it played its hand a little bit, is actually developing carbon capture and storage in the Cooper Basin as a priority. It's not about blue hydrogen for them. It's actually about carbon capture and storage. And the reason why they're doing that is because the Japanese have come to market and said the next round of contracts we're buying needs to be carbon neutral LNG. And if you look at the bulk of Australia's LNG resource, with the exception of the Queensland LNG players, which are largely coal seam gas, which have lower CO2 content, the next round, other than Beetaloo, which is yet to be proven up, is all high CO2 gas, right? So carbon capture and storage is going to be growing as a demand and a need within the market in any case. The other part of this slide is the economics, and this is an economic view without policy or government impact. Okay, this is just the raw economics, break-even costs of hydrogen versus the alternate fuel technologies that they could displace. So at a bit over $3.50 a kilo, and hydrogen is sold by the kilo, not at an energy level. At a bit over $3.50 a kilo, hydrogen becomes viable as an alternative for diesel and electric heavy vehicle transportation, particularly long haul. Okay, at just under $3 a kilo, it becomes viable for motor vehicles. Now, there's some of the complications with motor vehicles is, you know, getting the supply chain out there, but you know, we've got gas distribution networks that need a home for something to flow through their own real estate. So it makes sense that you can see a hydrogen network starting to be developed in the future as well. At $2.50 a kilo, ammonia production and refinery uses start to become viable. Okay, so that's your ethanols and whatnot that, you know, likes of Equenos or Incitec Pivot and Para and other companies are producing. That's about the economic break-even point of where you start to displace alternate fuels. You go further down that graph and you see steel making, power generation, gas blending, you know, heating. You know, they all have lower costs of hydrogen. That range between $4 and $2 a kilo is important. And if we slip onto the next slide, you'll get a view of why that's important. And I'm going to switch topics from hydrogen to ammonia. And the reason why we talk about ammonia is the most economically viable way of currently transporting hydrogen. So ammonia is NH3, so 3 hydrogen atoms to 1 nitrogen atom. Okay. Ammonia is quite diversely used, explosives, fertilizer, primarily fertilizer. And in this slide, what we talk about here is CF Industries and Yarra. So Yarra's got an Australian footprint. CF Industries is a big US ammonia producer. They all have a pathway to decarbonisation. I think it's pretty normal. What CF Industries are saying is that at a US dollar value, they can produce blue hydrogen-based ammonia at the same price as conventional ammonia. And they do that by virtue of getting access to US Section 45Q tax credits. Those tax credits are worth about $50 a tonne of CO2. And that offsets their cost of actually sequestering the CO2. In the last 6 months of the year, we've been working with the Australian government to do something very similar. So the Australian government, through the Department of Energy and Resources, is actually working on what's called a CCUS, carbon capture, utilisation and storage methodology, which allows you to access through legislation the emissions reduction fund. And what you actually get access to through that methodology will be Australian carbon credit units, which is effectively the same type of tax offset as the 45Q that we talk about here with CF Industries. That's an important step forward. In parallel, we've also been working with the Australian government around potentially funding the proving up of CCS facilities, geological formations in the Northern Territory, and we're hoping to have some news on that in the next month or so. I want to turn your attention now to the cost equation. So the cost equation, $140 a kilo of ammonia, right? That ammonia sells for circa $300 to $400 a ton. Okay, so the sell price of ammonia is a globally traded commodity, $300 to $400 a ton, depending on the market you're working in. That's US dollars. That $140 a ton of ammonia effectively equates to 14 cents a kilogram production cost. Okay, extrapolating that out, and this is some, I'll get a little bit mathematical on you, but 1 kilogram of hydrogen produces 5.65 kilograms of ammonia. So that 14 cents needs to get times by 5.65. And then you do the Aussie conversion, you're at about $1.07 a kilo in production costs. Okay. That's per kilo of hydrogen. So $1.07 per kilo of hydrogen at the gate, at your production facility gate. If I draw your attention to the blue graph, you've got the market value of hydrogen in low carbon ammonia. That's basically blue hydrogen based ammonia. And that's saying it's about $2,000 a ton US. That's basically taking your $300 to $400 a ton US, timesing it by 5.65, you get to your 2,000. If you then reflect back on where Dr. Alan Finkel said Australia needed to be producing hydrogen at, it needs to be $2 an Aussie a kilo. That takes you back to that $2,000 a ton, right? If you then go reflect back on the previous slide, you start displacing fuel in trucks at $3.50, fuel in motor vehicles between $2.50 and $3, fuel in ammonia production at $2.50, right? So what that tells you is a project like ours, assuming we can get production costs at sort of that $1.07 a kilo of hydrogen, which, we're having this conversation because we have some confidence that we can get there, means that, we'll have circa 600 million Aussie in revenues from this project, okay, once up and running. And that's based on 300,000 tonne per annum of hydrogen. It is quite feasible with the coal resource that we have, or we believe we have. I need to be careful because it's not a JORC compliant resource. But it is quite feasible that, we can do a lot more than 300,000 tonne per annum. So that's a little bit about the economics. I'm going to stop there because I know I've overloaded you with quite a bit of technical detail, but that's just sort of painting the picture on the hydrogen economy and the economics of a project like ours.
So on slide 17, basically what this says is, why do governments that are trying to promote a hydrogen economy care so much about blue hydrogen? Adam's nicely covered off the points about production cost. Scale is important. If you look at the current largest green hydrogen plant globally, it produces 3,000 tons of hydrogen per year, or that's its nameplate capacity. It hasn't even got there yet, but that's the kind of quantum that you're looking at. Contrast that to the biggest blue hydrogen project, which produces 3 million tons per annum of hydrogen. So it's a huge differential between the scale of these operations currently. And obviously, with the programmed demand that we're seeing, you need to have blue hydrogen in the equation to be able to satiate that demand. The other thing is consistency of supply. Obviously, if you're going to get people to adopt hydrogen as a feedstock or a fuel source, there needs to be consistency of supply. If you're producing using green energy, you do so when the sun shines or the wind blows, but that's not 24/7. So you need to have some kind of backup. An alternative would be to have a buffer, a reservoir of hydrogen which fills the gap, but you're storing hydrogen at negative 220 degrees Celsius. So, there's both a large OPEX and CAPEX component to building storage capacity. So actually having blue hydrogen and cogen hydrogen, as the EU report calls it, is a critical part of being able to have a reliable hydrogen network. If we flip forward a couple of slides into the project itself, Adam was talking about the different items of tick boxes that he wanted to see going into making sure that this project was actually viable. And those are really access to market, the CO2 solution, the resource itself, and the social license point that he spoke to. And so the rest of the presentation, we sort of drill into each one of those individual topics to show you how we've addressed those. And obviously, there's still work to be done, like the drilling of the resource, but why we feel pretty comfortable that we have killed all the critical questions. Okay, so slide 20.
So I think we've covered this already. What we spent a fair bit of time on is making sure we've got a carbon capture and utilization solution. As I touched on before, it's most likely that we'll use primarily carbon capture and storage. What I didn't talk about, and this is some of the differences between our process and what happens in the LNG world, because I know some people might be familiar with what's happening up at Gorgon. They're having problems with CCS. Gorgon's problems and good old Chevron keep a pretty tight ship, right? So they don't share much about what's actually going on, but they let it slip in one of the announcements that it actually had to do with impurities in the CO2 stream. And they do that because they're stripping CO2 through their chilling processes, or as they try to liquefy the LNG. We superheat the coal and boost it up between 800 and 1200 degrees Celsius. And at different temperatures, you get clear separations of the atoms. So you get a pure CO2 stream. So 99.9% CO2. That gives us a capture ready state for CO2. And then what we need to do is compress it and bring it down to temperature to move it into the carbon capture and storage solution. The other little piece of the puzzle that we're working on is a CO2 to H2 solution through an Israeli organization, or it's actually an Israeli institute. That's actually, we've got access to their technology in region. And one of the things we want to look at is potentially prototyping that, but that's not the primary focus. The primary focus is on carbon capture and storage in either the Cooper or Amadeus basins. If we go to the next slide, this is a good slide because what it does is it actually helps the naysayers actually understand, well, why the hell would you actually be doing coal in the middle of Australia, and why does this make sense? And it's really simple. We are right near, and I say right near is only 200 kilometres as if it's nothing, right? But there's some serious issues with moving CO2 anywhere on the East Coast through built up areas and into a reservoir that either exists or doesn't exist. In the Cooper and Amadeus Basin, we have reservoirs that are depleted. They are of the right geological formation to sequester CO2. And we're in the right area to do that. So if you were to try to do the same thing, and I don't know how familiar you guys are with some of the noise around AGL's Crib Point, down in the Mornington Peninsula. They're trying to build a 50-kilometre pipeline to move gas into the gas network that the Victorian community needs, and are being absolutely hammered under social licence for trying to move gas through 50 kilometres off the Mornington Peninsula up to the Victorian gas network, right? So even though there's reservoirs off the coast of Victoria, good luck getting there, right? And that's an important part of the message. You know, there are proponents down in that area that are talking about doing the same thing. They're talking about doing it with lignite, which is a lower calorific value coal. They're talking about doing it in high suburban built-up areas. And they're talking about sequestering CO2 into ocean-based wells. It's a fact that the cheapest way to sequester CO2 is into a land-based or onshore-based reservoir. If you then just say, okay, well, why wouldn't you take coal out of Queensland and gasify it in Queensland close to all that infrastructure and then put it into a well? I'd like someone to tell me where the wells are in Queensland. They've only got coal seam gas. That is not a reservoir that you can stick CO2 into, right? So you just look at the geology of the country. There's opportunity in the West, and you know that's a potential. But there's not a lot of coal in the West. All the coal in the West is down south, right? So you're then starting to play in the area where Leanne used to work with AWE, and yeah, that's potentially where you could run one of these projects. But there's not too much more, not without a good CO2 solution. And that's why, you know, I personally went from skeptic to believer. The project's got legs, right? You got the right geographical combination, and yes, you've got a transportation hurdle that you've got to get over. But by moving it as ammonia, there's a train line that runs through Alice Springs straight up to Darwin. That train line's hardly used. You know, during the PFS, we'll do the economics. We may end up even owning our own train. Who knows, right? And you know, that's what some of the coal miners have done in the past to reduce their economics.
So it's going to be rail, not trucks or pipeline that it gets.
Rail is the most likely outcome. Right. If we can solve the pipeline piece, I think that's a difficult part, because the pipeline, although there is a gas pipeline from Alice Springs all the way up to Darwin, it's used currently by Central Petroleum to move gas.
Right. Okay.
So right now our thinking is
rail's existing infrastructure you can use, the pipe's been used for something else.
Yeah. So ammonia will be the most likely transportation solution. This next slide really talks about a couple of different pieces around the social license, but also in partnerships. So, I've given some insight into my background at GE. We're in advanced conversations with a partner that's capable of building, owning, and operating the gasification plant. To put that in context, that's $1.5 billion, $2 billion worth of cost. That's not a cost we need to worry about if we're successful. Okay. We've been in conversations with the government, both territory and federal. We're working on the carbon capture, utilisation and storage methodology. I know who's working on that. Santos is, a few other players. There's very few else in the country that are actually involved in those things. We're in deep discussions with the potential carbon capture and storage locations, and they're incentivized to work with us. They're incentivized for a couple of reasons. A, as their own production is going to need carbon neutrality, they need carbon capture and storage. B, our thinking is through credits, they'll get some benefit out of it economically. C, there will be more and more gas that needs to have carbon capture and storage associated with it in this country, particularly given the comment I made earlier about the Japanese seeking clean LNG. We've been in conversations with One Rail, which is the old Genesee and Wyoming organisation, who I know quite well from my days back in GE. So, we've got a number of different boxes ticked that, or close to ticked, that work in our favour, that give us confidence at a high level that this project's worth taking through to pre-feasibility. Move to the next slide. Gasification. Most people in Australia don't know about coal gasification. That's because there isn't any in Australia, but they're all over the world, right? This is technology that we at GE used to sell into China, South Africa, and the US. Personally, I've had some involvement with the stuff in the US. So it's known, it's quantifiable, it's stable. You know, this is not, you know, some harebrained idea about drawing air out of the Simpson Desert and, you know, running it through an electrolysis and getting hydrogen out of it. This is known technology with known solutions. So if we go to the next slide.
Yep.
Just very quickly, you know, obviously our mantra is to keep things simple, but during the PFS, we will look at some interesting innovations like directional drilling for the coal. Our base case is to use a mini wall. We only need 3.5 million tons a year, but this directional drilling methodology, which is becoming popular in the States, is lower surface impact and also lower capex in terms of coal extraction. And then the other thing is, you know, we have a technology partner who's a global front runner in terms of building these plants. We have had conversations with the CSIRO about how we bring green elements to the plant also. Obviously, where we are is one of the highest gain solar areas in the country. So to the extent that we can supplement in green components to our blue hydrogen, we will look at the viability of those as well.
We've talked about the location. I won't labour that. There's probably the highlight on this page is we've also been talking to NAIF, the Northern Australia Infrastructure Fund. We tick a lot of boxes for NAIF. We're just too early for them to invest in. NAIF is debt funding. Really, that's post FID. We build community, we build infrastructure, we build manufacturing, we build exports. You know, they are the things that NAIF's seeking.
Adam, do you want to talk to this? Basically, one of the things that is on the cards at the moment is a pipeline between Alice Springs and the Moomba hub. Essentially, while we're looking to export ammonia as a first stage, one of the options which could be down the track that you're seeing in the European Union, for example, is a hydrogen blend into the gas network. So we would be ideally suited to be able to tap into that pipeline and feed hydrogen to the Moomba hub for the Eastern Seaboard distribution.
This slide here talks about our potential resource. And Leanne, do you want to just point to the wells that Central Petroleum drilled in 2009? See those wells? Our tenement's right square in the middle of it. Those wells defined 300 billion tonnes of coal at less than 1,000 metres and 1.4 trillion tonnes of coal down to 1,500 metres. So we're pretty confident there's enough coal there. The coal started at 235 metres, and our well that we drilled back in 2014, DH1R, we struck coal at 500. Yes, it's deep. We know that, right? But we're looking at technologies that actually allow you to mine at those depths. People have been mining at depths greater than 500 meters for 40 and 50 years, right? So it's not an uncommon process. It's just a bit different. Mm-hmm. The picture on the left here is the two yellow bars are the wells that Central Petroleum drilled between CBM 1072 and CBM 1071. Yep. We drilled one right in the middle of the two. And that's the grey line you can see, and that's the correlation of the coal seams. Okay. Okay. We're pretty confident we've got enough coal there to do what we need to do. Yeah. The other thing, we've got that little star on the diamond on the map. That's coal at 235 meters below the surface. And I was reflecting on some stuff I was reading today, just some feedback. I don't know if you've been up in the Hunter Valley, but I drove past it during the weekend. Yeah. And those open cuts are 300 plus meters deep, right? So this is not unexplored territory.
Okay.
So, you know, it's yes, it's got some challenges, but we're pretty confident we've got enough coal and we're in a good location to sequester the CO2, and that's the important part of this puzzle.
Okay.
So we've jumped forward a few slides, but this slide basically shows the milestones that we're expecting to tick off over the next 12 months. Most importantly, we want to complete the PFS before the end of the year. In the short term, we're looking to confirm and announce our technology partner. And I know we're being very sort of mysterious in terms of the identity there, but until we have that documentation signed, obviously we have to be a little bit careful, but that should be subject to a market announcement in a matter of a couple of weeks. The initiatives that have been going on with both state and territory governments should start to bear fruit as well. The drill program we're looking to kick off late May, June, and so within a couple months of then, we should hopefully have our JORC resource defined. The conversations both on a practitioner level and on a government level around carbon capture and storage will start to get formalized, as will conversations around infrastructure with rail, pipeline, port, and so on and so forth. The final thing that we have there is discussions around offtake. We hope to have a number of MOUs in place before the end of the year. We have had some very lively inquiries, especially around the ammonia side of things, pertaining to Japan of late, and so obviously we're going to progress those as quickly as possible, because that is one of the main determinants of whether we end up producing 300,000 tons or a bigger number. Is really all about sales. Obviously, from an efficiency point of view, if you're going to build something, you might as well build it big. 3.5 million tons of coal is a small coal mine, so being able to scale that up obviously helps us from a cost perspective as well as increasing the bottom line.
Well, as Chris said earlier, you know, economics talks, right? It's getting that right balance between production, volumes, and offtake.
Yeah.
Yeah. And given just the current size of the hydrogen market, let alone what the growth projections are, we're pretty small. You'd have to build, I think, 6 of our plants per annum to keep up with the growth that's projected for the Asia Pacific region.